Advice for me, I'm wide open to it. This is my first time doing glasses, and I'll just say it is frustrating. But well, let's looks like we've slowed down with new people coming in, so let's go ahead and get started. I am thrilled that all of you are here. This looks like it's going to be a well-attended meeting. I want to ask all of you, there are going to be a few parts of this that I'm going to ask for your input. Please volunteer. Don't be shy. I know it takes a minute to shut off your mute button. If you're somewhere that's not terribly noisy and want to leave your mute button off, you can. But I want you to be prepared to help me with my math, and I hope my math this time is better than some of my last presentations. So hopefully that works. So with this, we'll go ahead and get started. We're going to talk, we've talked a lot about debt service in the past, and today we are going to talk about the impact of debt. And that goes beyond just debt service. So there are, as we all know, positive and negative impacts of debt. I have compared using debt to using a chainsaw, right? In the right hands, it's a wonderful tool. In the wrong hands, it'll cut your head off. We are talking about this within the context of increasing our gross product. Increasing our indebtedness can often be done to increase our asset base. And when we do it, we always need to think about risk. We're going to talk about each of these parts as we go. And I want to make sure we sort of touch on each of them. Debt is like many things, kind of like politics, can become a very emotional topic really quickly. And I feel like there's plenty of room for most of us to run our business however we want. If you are not comfortable with debt and don't want to have anything to do with it, I have all kinds of respect for that. If you feel like you want to, do everything with debt, that also can work. So I think as we talk about this, hopefully we make the reasonings for those feelings clear. I'm going to review again. I've done this on the last few presentations about gross product. I want to review this again. The total profit equation is where we take the gross product and then we subtract the direct costs, we subtract the overheads, and that leaves us with net income, or in some countries, they actually call that profit straight up. Canada is one of those countries. If you use QuickBooks in Canada, instead of net income, they just call it profit. Importantly, debt service is not included in profit, and profit is not cash flow. So don't forget those things, please. Gross product is the economic value that you produce, right? Revenue is the cash that comes in. Gross product is the economic value, whether you choose to sell it or transfer it to another enterprise within your business or just hold on to it. Retained heifers are a great example. They increase the value of your herd without necessarily a cash transaction. So we want to be careful that we pay attention to both the cash and non-cash transactions in our business. And gross product also helps us to remember silent thieves. So non-cash costs can help, can really hurt us. So for example, we often don't pay ourselves for the feed we grow, but it is in fact an economic cost to the business when we feed it, whether we pay cash for it or not. The trading account is where we calculate the gross product. And I've showed this multiple times. Hopefully you're getting comfortable with it. We have the opening and closing inventory included. We have our sales, our transfers out, our transfers in, and our purchases. Any questions to this point? Anything you want to add there, Walter? Okay. This is review, so don't feel bad if you feel like you're in deja vu mode. All right, we've seen cases where you can have a great gross margin ratio and still not have a profitable business. Ultimately, you pay your bills with dollars, not with any kind of ratio. And so usually we want to make sure we come back to that. And as we've mentioned, in an asset-intensive business, the asset performance times the volume is what ultimately generates the gross product. So if we have a bigger cow herd, it's simple multiplication, right? Volume times quantity, if you will. And so when we multiply the number of animals times the return per animal, that gives us the ability to alter any of those three variables in that equation. But they are tied together. All right, one of the things that we often forget, we all like to complain about debt. I don't know anybody that doesn't wish they didn't have debt payments, with the exception of maybe Thane Russell. If you know Thane, he's a Canadian oil man who ranches also. He gave one of my favorite EL continuing ed talks called Better Living Through Leverage. He is an oil guy, so naturally very aggressive about debt and very risk tolerant. But one of the things we do is we often separate the debt. So we don't necessarily like paying our mortgage, but we do like living in a house and we do like living on a ranch. And so when we think about the debt, I often want to think about that, make sure we think about that with regard to the asset that it secures. And that could be land or livestock, feed. It can be a number of other things. We also have we have different types of debt. And this becomes very important. I'm not going to go into this in detail. We will do this another time. But we have good debt, which I define as debt used to secure assets that can produce income. We have bad debt, which is debt used to buy things that don't produce any income. Sometimes those things even produce more expenses. And then we have stale debt, or sort of debt you're behind on. And then toxic debt is like compound debt, where you've refinanced, you've termed out short-term liabilities that you haven't been able to pay, further reducing your ability to pay liabilities in the future. For our discussion today, sorry, where did I get to? Yeah, for our discussion today, we're only going to talk about things that are potentially good debt. So not all potentially good debt generates more profit, but that is where we are going to focus. So I'm not talking about buying a 60-inch TV on a credit card. We are talking about, buying more cows, more sheep, possibly more land, but generally not, but, more assets that are going to produce cash flow. Okay, debt, as I mentioned earlier, adds risk, and it adds it from a couple of different places, and I want to make sure we always understand the different sources of risk. The first one is when we finance an asset, such as a stocker calf or a cow, there is a real risk that the underlying asset will decline in value. I think most of us are probably familiar with, debt to equity ratios or debt to asset ratios. Your bank probably has some rules about that. If we buy a cow for $4,300, for example, and we finance, let's say 90% of that, and then the market drops by 70%, we could get ourselves in trouble. The second major risk is repayment risk. And this is one I feel that a lot of people don't consider fully. There are multiple risks in repayment. And the most important one is, do we have the cash by the deadline? So we may buy an asset which produces economic value, but which we cannot convert to actual revenue by the time our payment is due. Now, depending on your bank may be a little flexible on these types of things, depending on the type of note you've used, but there is a point where there is a deadline and there is a dollar amount. And both of those things reduce our flexibility, and sort of very naturally, but a very sort of flexible, movable system, such as our production system, which is dependent on markets, weather, and all those things, and puts it up against a banking system or a financial system, which is very rigid and does not have a great deal of flex in it. And so the question I will ask you now, this is a part where I'd like you an answer, is what protects us from these two different types of risks? And Walter, if you have more risks you want to add, I'd love to hear them. Or anybody else for that matter.
Well, one risk I think, John, that we have there, that we might want to think about when you had the three pots. I think that sometimes we can say there's a revenue risk too, because the revenue risk, if you're working with your banker or whatever, they're looking at maybe certain pieces of working capital, but sometimes you have to get the bank to give you their guidelines, and I
Yep.
think that's a once you understand. I don't want to say it's a game, but once you understand the rules, then things kind of open up.
Yep. Totally agree. Great thoughts, Walter. Thank you. All right, for the rest of you, what protects us from the risk inherent in debt? Brett, I hope you're prepared to answer a few questions today. Glad you're here.
I'm
Yes, who's this? Michaela, how are you?
I'm good.
Good.
I would say working capital.
Okay, explain that a little bit.
I think if you have enough working capital, especially if you leave enough margin beyond your operating expenses, then that can serve as a way to pay that debt if you get in a bind.
You bet. Great. Very good. Thank you. Just for the rest of you, Michaela happens to work in finance on the other side. So that's awesome. Good. All right. What else? What buffers us from risk?
Cash flow.
Very good. I totally agree. If you have good cash flow, the repayment risk is significantly lower. What else? Thanks, Grant.
I have an outside job that buffers me from some risk.
Good.
Yeah,
Alternate
if
sources of income. Yeah. And again, that plays into Grant's cash flow, right? Great, Alexis. Good. What else? Oh, come on. We can get a few more. Don't be shy. Joy, you might have an idea, huh? Tyson, I'm sure, has an idea. All right, you're going to hold out and make me go
Liquid
ahead.
assets.
Yeah, liquidity. Good. And Michaela had mentioned working capital. Yes, all of those things, right? The ability to come up with cash. All right, so let's talk about what protects us from the risk. I love the first one. This is one Wally harps on all the time. Margin protects you from risk. If you have a really big profit margin and it doesn't go quite the way you expect, hopefully your fallback position is still pretty reasonable. If you start with a 2% margin and it doesn't go very well, you're in trouble a lot faster. Whereas if you have a 50 or 100% margin, that you're working with from the beginning and it doesn't go well by half, well, you're probably not too bad off. Cash flow is mentioned. Degree of leverage. So are you 100% leveraged? Are you 200% leveraged? Are you 10% leveraged, right? That makes a big difference. There's some pretty easy math to go through when we're looking at a market drop like we saw in 2016 and like we may see again in our lifetime. Where, if the market drops 70% and you are 70% leveraged, you're probably in a tougher position with the bank than if the market drops 70% and you're 40% leveraged. Insurance is another great tool. We have a couple available to us, and LRP is one that I think of right now as a potentially good option. Many of you have heard me say I'm not a huge fan of LRP, but if you take this week as an example, you can essentially contract or LRP an 850-pound steer at like 265 for October delivery. So that is one way. There's also hedging and contract sales, but various form of price and or production insurance. Proper repayment terms. I see a lot of cases where people mismatch the underlying asset and the loan that they use to secure that asset. So if you are buying a long-term asset with a line of credit, you are potentially setting yourself up for trouble. And conversely, if you're buying a short-term asset with long-term debt, you also could be setting yourself up for trouble. We want the term of the asset to match roughly the term of the loan. Sound, and I'm going to say resilient production systems are another good way to mitigate risk. If you are constantly running your operation at the, sort of at the edge of viable, That's going to, eating every last blade of grass, for example, that's going to be a problem if there's a weather or, climate type event. And then there are obviously others. We could talk about these types of risks for a long time, but more than anything, I want you to be aware of the risks, and I want you to mitigate the risks that you can. We often talk about the fact that there are lots of things outside of our control. From a probabilistic standpoint, I'll claim that we have a lot more control than we let on. And sometimes that's a matter of, prior planning can really buffer us from potential bad outcomes. All right, when we look at debt impact, there are sort of three main things we're going to look at. The first is return, and we're going to look at return on assets and return on equity. But I want to make sure we understand that return on assets is net income, not including interest, divided by total assets. And when we look across industries, we see that 25 to 50% is considered good. And in our practice, we see numbers up to and over 100%. So there is, in theory, with ROA, there is no upper limit. There are practical limits, but there is no reason, for example, that it can't be a number greater than 1. Cost of liabilities is a slightly different way of talking about interest. And what it does is basically take your total interest payments and divide it by your total liabilities. So imagine that it is your, average effective interest rate. I'm going to tell you again that interest rates feel high right now, but they really aren't. I had the opportunity at the Wyoming Bankers Conference a few weeks ago to visit with a guy who started banking in 1977. He is now retired. I asked him what he thought of current interest rates, and he thought, they're great. I've seen way worse. And we had a wonderful visit about that. Long-term average, if you go I think I went from the 60s forward to about now, the average is a little under 10%. Our prime rate right now is at 8.5%. Long-term borrowing is usually a little lower than that, depending on your situation, credit score, bank, and all that. Short-term borrowing might be a little more than that. But 8.5% is a reasonable, compared to long-term rates. And remember, the early 80s were 18+%. We have gotten very used to very low numbers like 2.5%, 3.5%, or rates under 5%. But at 8.5%, we're fairly normal. And then, as I mentioned before, one of the things we use to control risk and also to calculate the impact of debt is leverage. And that leverage we're going to use is the debt to equity ratio. So how much in the business, how much of the money is your money versus how much of the money is someone else's money. I want to make sure remember a few definitions or introduce them if you're not familiar. Equity is an important concept. The simplest definition of equity is just your assets minus your liabilities. And that is essentially what, that's what you own in the business. That's what your value is. And then, as I mentioned a minute ago, debt to equity ratio is simply the total of your liabilities divided by your equity. Again, this number, the equity number is a dollar number. The debt to equity ratio there is a bottom limit of 0, right? If you have no debt, then you would have a 0% debt to equity ratio. And then you can borrow more than you have equity. So that number can be larger than 1. I'm going to re-illustrate Kiyosaki's financial model. There are a few things I want to talk about here real quickly. The first one is, again, your balance sheet. The top part is composed of assets, according to the bank. The bottom half of your balance sheet is liabilities. If you subtract the liabilities from the assets, you get equity. I've mentioned this a few times, and I didn't draw any arrows on this, but Kiyosaki does a great job of illustrating the fact that different businesses and different situations the money can flow different ways. Sometimes we bring in income, we pay our expenses, and we use the profit to buy assets. Sometimes we use the profit to pay liabilities. Sometimes we take out a liability to buy an asset, which then can generate income. There are lots of different ways money can flow through this system. What we want to be pretty aware of is how it flows in our business and what that means for our profit potential, what it means for our risk, what it means for our activity level. Any questions to this point? Walter, anything you want to add?
No, John, I think that that's a pretty good summary. I think it's going to be interesting to delve into your debt to equity and get an understanding of what the impact that is on the ROA.
Good. Awesome. All right. So we're going to play the same game we've played the last few weeks. I'm going to show you some businesses, and I'm going to reveal more information as time goes on. So the first one is cost of liabilities, which, if you remember, is basically an average interest rate across all activity. So we have businesses number, enterprise 1 through 5 with different relative rates for interest. Anybody have any preference on which business they want to be a part of? Get it coming out of the gate? And I'd like at least a few of you to pick. Walter is going to pick 4. Okay. Why 4? Because it's 2%
low.
interest, right? Yeah, good. All right. Anybody else? You can do it in the chat if you want. If I can see the chat. I don't know if I can see the chat the way I'm set up. There we go. I can see the chat now. Another 4 from Hondo. Good. Oh, good. Brett, be careful loading the sprayer. That's good. 3, Tim. Tim doesn't mind a 6% interest rate. I like it. Michaela, Enterprise 4. Good. Same. 4. All right. Good. Let's go on. We'll see what the next line gives us. Now, we have cost of liabilities on one side, total assets. Anybody want to change their vote? Anybody have an opinion on which business they want to be part of next? Sam is 2. Michaela now has moved to 2. Good. Oh, Honda moved to 2. Why do you say that? Michaela, would you volunteer, or Sam?
I pretty much just like the assets.
Good.
And 6% is acceptable.
Okay, good. I like it. Sam, same reason, different reason? Sam might not be able to talk. I assume you're not in a meeting. Tim had picked 3. Okay, good. Got a little bit of variety there. All right, let's go on a little further. Now, I'm going to jump a bunch of info at you here quickly. So remember, cost of liabilities is your effective interest rate. Total liabilities is what that interest rate is calculated on. So each of these businesses have a different total interest paid. Okay, so we might have a very high interest rate, but a small liability, but a big interest payment, or a moderate to relatively low rate on a large liability for a larger cash amount. Remember, equity is simply your assets minus your liabilities. I would like you, if you would please. Tim, good. You don't know what a liability is. Perfect. In case that is general, and he's not kidding, liability is debt. So your liabilities are money you owe to other people. Okay, Hondo likes 2 because it's got scale to it. I like it. Dana's back to 3. Okay, now go ahead, Hondo. You want to add to that?
No, sorry, I thought I was muted.
You're all right. Dana, you want to explain your choice on 3?
I like that the liabilities isn't like the others, it's over half or more of the assets, and the equity is 570.
Okay, good. You understand what she's saying? So she's got liabilities. If you multiply this by 2, it's 460. Her equity is double that. So she feels comfortable in that, at that level of leverage, and probably feel reasonably comfortable with that interest rate. Might even wish we were all paying 6% interest right now. All right, so let's go through these. Let's go through these, and I would like you to calculate the debt to equity ratio. Do you remember how to do that? If some of us will do it for Enterprise 1, somebody pick Enterprise 2 all the way out to Enterprise 5. Debt to equity ratio is debt divided by equity. Who would like to volunteer a number for an enterprise? Jordan, are you on here, I hope? You might have left. Oh, no, he's here. Please check our work. Walter, you can do that too.
Right.
I'm on, but I'm outside fixing fence, so I can't guarantee I'll be real quick on anything.
That's all right. But he's doing real work here.
Yeah.
Oh, Kevin, I'm going to have to get you to explain. I'm going to have to get you to explain 2 or 4 rather. Enterprise 4. All right, let's get some volunteers. Who's got a number? I keep learning that math is about repetition. So the reason I make you do these yourself the first time is because I think most of us learn by doing here, and the more of them we do, the better. %40 gave Caleb. Number 3. So how did you get to that, Caleb? Can you answer?
I divided 230 by 570.
Okay. Does that sound right, Walter?
Yes, sir.
Very good. All right. Hondo said, I missed you, Hondo. I apologize. Is 87%. Okay, so
No. Yeah, that was wrong. I was doing asset to liability.
okay, good. So let's think about that one.
So number one's like 700%.
Yeah, it's like 7. Yeah. Very good. Tom, welcome back. Glad you're here. Okay, so we've got a number for 1. We've got a number for 3. How about 2? What do we have? This is like a gimme.
Yeah.
1 to 1.
1 to 1.
1 to 1. Very good. What's 4?
7.
Okay. And what's 5?
1.5.
Okay. So Tara, yes, there are a number of them that are higher than 1. And we're going to go through this a little. So 7 and 7, 1.4 and 1.5. Everybody understand how we got to those numbers? Speak now or forever hold your peace. All right. So anybody want to change their vote? I was going to ask Caleb. You said, was it, no, Kevin, you said number 4, business 4. Why do you like that one the best? Maybe he's not there. That's all right. All right, we're going to move on. We're going to get to pick, we're going to get more information and get to pick more. Now I'm going to blow a bunch of stuff at you here because now we're going to look at the actual operating part of the business and how that's doing. And what we see is a variety of operating profit margins, gross profit margins. We see a variety of overheads, and then we see some net income. So how many of you, let's go ahead and pick a business here. Which one do you want now? Number 4 still look good to you, Kevin? Walter, which one did you start with? 2?
I started with 4, but
Okay.
I'm changing my tune.
Good. Do you wanna pick a new business now?
I would pick a new one.
Okay. Good. I think most of us can probably agree that enterprises 3 and 4 probably not in the running. All right, here's the next thing. Not sure how to work this thing. All right, that's all right, Kevin. Oh, Michaela likes number 2. You want to explain a little, Michaela?
Well, there's a lot to look at, but I like that the net income is the highest on 2. I
Mhm.
also like that the overhead seems reasonable for the amount of income or the amount of gross product. And I could see one, but I'm still concerned about the cost of liabilities.
Okay.
And if you could scale it, the 70% gross margin looks good.
Yeah.
But I guess I feel more confident with number 2.
Okay. Sounds good. So funny enough, remember 2 weeks ago, I made a bunch of changes last minute. I went back here about 30, well, it would have been an hour ago, 30 minutes before we started, and I was going to change one to make it a little sexier. And I got partway through it and realized, oh, I've done this before where I make changes right before the presentation and it bites me. So, all right, now here's what I want you to do. I want you to calculate the ROA. What is the return on assets? So that is the net income without interest divided by the total assets. So for enterprise 1, what is it?
50.
What'd you say, Walter?
50%.
Okay, 50%. Correct. How about for enterprise 2? You don't have to be an accountant to answer these.
All right.
5%.
Number 2, super close. It's easier than that. 100,000 divided by 1,000,000. 1 divided by 10. 10%, I'll claim.
No.
Oh, that'd
No.
be return.
Oh, I'm sorry. 5% is right. I apologize, Hondo. I looked at the wrong line. Good. You got me. Sorry. Life's hard when you're a dummy. What's the return on asset for 3 and 4?
Not very good.
Not very good. It's negative, right? So, I mean, we can pretty well just discount it whenever it's negative, but it would be negative 100,000 divided by 800,000. You used $800,000 in assets to generate $100,000 loss in each of those cases. And
Looks
then,
like
go ahead.
Looks like my business.
And then in enterprise 5, 30,000. Whoops, excuse me. Well, there we go. We'll go to the next one anyway. Hang on. Back. Next one would be the 30,000 divided by 80,000, right? Okay, so 38%. So what you can see is there is a wide variety of return on assets here also. And again, I would like you comfortable thinking about this. This is the return generated from all of the assets we own. Doesn't matter if we've borrowed money or not. All right, now the number table here just keeps getting bigger, so I apologize if this starts to look intimidating, but I want to walk through our actual debt impact, and I'm not going to quiz you about this because I haven't shown you how to do it yet. But our debt impact, effectively, we're going to look at our return on assets, which, let's use enterprise 1, is 50%, okay? Meaning we have... Well, how did we calculate that? We have a net income of 40,000. We divided that by 80 to get 50%. Interestingly, we have, as you recall, a 25% cost of liabilities. 50% return on assets is 25% higher than our cost of liabilities. That's really 100%, but it's 25 percentage points higher. Okay, so we take the return on asset and we subtract the cost of liabilities. Everybody follow me there? Can you see my cursor on the screen?
Yes.
Okay, great. Then we take that and we multiply it by our leverage. Okay, what is our debt to equity ratio? Now, Walter, I don't know if you've played with this. It seems to me at the extremes, debt to equity, debt impact gets a little wacko right at the edge. Like in moderate values, it works very well. When you get out to the extremes, it starts to bend a little.
I'd say that's probably right. Yeah.
Okay. This is a heavily leveraged business right here, enterprise number 1, with a very high interest rate. And yet that the return on the business makes it so that there is a very reasonable return. There is a very good impact of borrowed money. Is that a fair assessment? As opposed to enterprise number 2, Michaela, which has a very reasonable cost of liabilities, right? A very reasonable interest rate, but it has a lower return rate. So any money that is borrowed in this enterprise actually reduces our profitability. Okay. And so it has a negative debt impact. And then when we go, obviously, our 2 businesses that lose money, those, we're going to talk more about that situation here specifically. And then enterprise 5 has a pretty significant return on asset, and it has a slightly above reasonable interest rate to produce a pretty nice debt impact. Walter, you look concerned.
No, that's good. You're good.
Okay.
You're doing good.
Good. All right. Any questions to this point?
Yeah, John, I have a question.
You bet.
So when you look at these overall in all of this, which would you just say 1 and 5 are doing the best, or like, well, how do you scale when there's so many moving parts to this? How do you decide, like what's going well and what's not?
Okay, so I'm going to tell you right now that I gave you a bunch of stuff on this page in part to sort of add noise. And I really want you to start to look for the parts that are important. There's a whole bunch of this stuff that is not that important that we can just ignore for now. And yes, in these cases, number 2 business started out looking pretty good, right? Until we got to this 5% ROA, okay, and a 6% borrowing rate. So if I'm going to borrow money at 6% to make 5%, I've got a problem. Enterprise 1 and Enterprise 5, which have a return that is significantly higher than their borrowing rate, mean that debt is helping these 2 businesses. I'm not going to tell you any of these businesses are better than the others, so please don't take it that way, because it very well may be if you take the debt out of these others that they improve significantly. But I think we can sometimes get, for example, who's going to sign up for a 25% interest rate? Well, nobody. But if you have a 50% return on asset, it's a big gap. And I want to get you thinking about the difference between the value, as Wally says, it's not the number, it's the relationship. What is don't think about the percentage figure, think about them relative to each other. The relationship is the part that matters. Does that answer some of your question, Tara?
It does. Yes. Thank you.
Okay. All right. Borrowing money at 10% to make 5% is a bad idea. We see that a lot. So I don't want to sort of lead anyone the wrong direction, but we see lots of cases where people have very high return and they are very, very hesitant to borrow money. Now, again, I've mentioned that some of that is personal taste, right? If you are a Dave Ramsey acolyte and never want debt in your business, I will fully support you in that. But that said, if you have a high margin business and have the opportunity to improve it or increase it with debt, I'm not against that. As we talked about, we started this with a discussion about gross product, and one way to increase your gross product is through debt. I want you to think very carefully about if you're increasing it a little bit with a lot of debt, that's a problem. If you're increasing it a lot with a little bit of debt, that's a wonderful thing. All right, Derek, do the benchmarks change if the business is land owning or land operating? Yes, the performance I would expect would change, but the underlying principles are the same. Definitely the risk of debt in a land business, in my mind, is higher because generally the ability to make payments is harder. But if you are appreciating and cash flowing at one rate and borrowing at another rate, we have to know the relationship between those 2 things. Really good question, Derek.
Hey, John.
Yeah.
So in my trucking business, I had a rental truck, right? So I had no
Yeah.
debt for
Yep.
a loan on a semi, and I was paying around $5,000 a month to rent that truck, which is
Yep.
super high. And then I ended up getting a loan for 23% to buy my own truck, which my mom was like, "You're crazy, like that's stupid," you know. But I ended up saving almost $3,000 a month by taking a 23% interest
Yep.
loan, and I've since got that down to 10. But I think that like as a young person, no one wanted to lend to me, but it still made sense. So
Yep.
isn't the ratio sometimes like skewing when like you have to look at like, well, what is the alternative to the high interest debt?
Great. That's another great. Yeah, there effectively is an opportunity cost there, right? Your opportunity cost could be the rental rate, or you could compare it the other way and make it the payment rate. But yeah, really good point, Alexis. And I agree with you. Sometimes we're in situations where we have to borrow expensive money for one reason or another. Your productivity in your truck makes it so that that is actually a good, we'll call it a good investment on the truck. So great, good illustration. Whereas you would be correct in that someone like your mom might say, boy, don't, and I'm not picking on your mom, so please don't take it that way, but don't take a 23% interest rate, and yet you wind up making more money.
Yeah, because she was only looking at
The
like, oh, it's going to take forever to pay it off, but she wasn't looking at the fact that okay, if I'm saving $3,000 a month, I can still make more money overall versus like I don't mind paying the interest versus um and I have an asset now, and where before I didn't own anything.
Yep. Very good. Walter, you want to add anything to that?
No, you're doing well on that, John. Because that I mean, there's some really good stuff down there on where is you making any money on your the borrowed money, et cetera. I mean, those are key components down there in that, next to the two lines that are from the bottom.
Okay,
2 to
good.
3.
Excellent. Good. Yeah, let's go there. The first point I want to make sure I clarify and revisit here. You can have a profitable business with borrowed money that debt has a negative impact. We have the obvious cases here where you have an unprofitable business, right? In those cases, debt compounds that unprofitability. But in enterprise two, we are walking this line of we're just marginally profitable and our interest rate is higher than our profitability. This was a real problem the first year that interest rates jumped up. And you're going to have to refresh my memory. That was 2 years ago now, right? Or 1 year ago. Either way, when interest rates went from 3.5% prime up to 8.5 prime, there were a bunch of people that got caught with relatively low performing businesses that now had to pay a much higher interest rate. I think we should always be doing a little bit of sensitivity testing on our businesses to see what would happen if our interest rate went up. Now, again, it matters how leveraged you are also, but because that talks about the risk, but it doesn't matter how leveraged you are. If you're more than 0% leveraged and you're borrowing below your return rate, you are going backwards. All right, so what we've done here is I've tried to break this out, and the numbers here the numbers I'm going to show you later are a little bit wonky, so they won't line up exactly with this, but they're going to be awfully close. This is a case where we have money made or lost from the equity. So in this business, if you recall, I believe we have $10,000 in equity, and we have a ROA of $5,000. So that means we made $5,000 from our money. The 70,000 of liabilities of someone else's money that you invested in this business also generated a return of 50%, but we need to subtract the interest. Okay, so effectively it didn't make 50%, it made 25%, and that gives us the $17,500. So in this case, even with a 25% interest rate, the bank's money made more total money than mine did. Okay, giving me the opportunity to not only service that debt, but also to increase my equity going forward. Okay. And business number two, right, earned $50,000 on their own equity. So they had $1 million worth of equity. Okay. And they cost themselves the debt, actually, the bank's money invested to return 5% at a 6% interest rate lost them $10,000. Okay. And so this is, again, a good case where we see a business that is profitable losing money. Now, this is also a place where when we think about opportunity cost, we can say that our money made money, but if we added an opportunity cost to our money also at 10%, we would see that that doesn't, or at 6%, that also doesn't work. And at 10%, it's worse. So this is a marginal business at best. Borrowing money into a marginal business is not necessarily a great idea. Retaining money in a marginal business is not necessarily a great idea. This is where it gets fun in 3 and 4, because in 3 and 4, not only have I lost my own money, my own equity lost money, okay, but then I lost more by adding the bank's money. And in this case, I lost more from my own equity than I did from the bank's money. But in this more heavily leveraged situation, I lost a little bit of my own money and a pile of the bank's money. And this business, in my mind, is at extreme risk. This Enterprise 3 is at a lot of risk because you have to come up with an additional $43,000, basically. Enterprise 4 is at even greater risk because you don't have much money in this deal to start. Enterprise 3, you've got some equity, right? There's $570,000 worth of equity. Enterprise 4, you have lost, not only did you erode your equity by $12,500, so you're down to $87,500 of your own equity, but now you have to come up with an additional $100,000. This is a very, very bad position. The bank is probably going to go backwards on you here quite quickly. The bank with Enterprise 3 might hold together for a year. I wouldn't want to do that multiple years in a row, but Enterprise 4, you're going to be out fast. And Enterprise 5, I think, again, with a reasonable amount of their own equity. Okay, this is 40%, right? 1.5 times. This is your money made $12,000 and the bank's money made $12,000. So again, a very nice business to borrow money into. You have potentially, this is again after debt service, so you have potentially increased your equity and allowed yourself to retain more earnings going forward. Oh, I'm sorry. I did this wrong again. All right. One of the things I would like to do, this is our next exercise, and I think a few people have done this already, is let's calculate the return on equity. So we've talked about return on asset. I want to also emphasize return on equity. And Walter, I forgot to put in a slide for the quick test. Maybe you would talk about that for a minute, but let's come up with ROE numbers first.
That'd be great, John.
Okay, so return on equity is what? What's the formula? Anybody know it? I'll tell you because I didn't tell you earlier. It's net income divided by your equity. So return on assets, right, is net income divided by total assets. Return on equity is net income divided by your share of those assets or the equity. So what's the equity from enterprise number 1?
4.
Sounds good. 40,000 divided by 10,000, 4. Or 400%. Yes. Does that sound good? Do we need to calculate? Yeah, we still need to calculate the return on equity for enterprise number 2. So we've got a net income of $100,000, an equity of $1 million.
$10%.
Okay, very good. Which is the number I tried to convince Hondo of earlier for the return on asset incorrectly. Good. Business number 3, we have net income of negative $100,000 and equity of $570,000. We don't really need to calculate that, right? It's an unfortunate negative number. The same for enterprise 4 and enterprise 5. No volunteers. I'm going to say that it's about 94%. 30,000 divided by 32,000. It's a very nice, these are very, 1 and 5 are very nice numbers. All right. Okay, so sorry, let me go back. Any questions about this? Okay, before
I don't know.
Go ahead, Walter. Did I get one of these wrong?
I would say you really got to be taking you really got to be taking 22.5, John, on number one and dividing that by 10,000.
22.5. Where are you getting that?
It's 40,000 minus the 17.5.
Yeah, is that not what that is? No, because I did return on equity without the interest in it.
Yeah, you don't do it that way.
Correct. It should have the interest in it. So actually, all of those numbers are a little off.
Yeah, because it's 22.5.
So, all right, good. So it should be 22.5 divided by 10,000. So it should be 2.25 or 220.
Yeah, it's 225%.
Yep, very good. And then enterprise 5, what would that be?
It's 38.25.
38. Good. Does everybody understand the difference? Walter is subtracting the interest off first. And that was the reason I included that number there, was to do the division. And then I proceeded to not do that.
Yeah, and then number 2 is 4% too.
Okay, good. Thank you. Who said something? Go ahead.
Yeah. So is this equation, like I'm always looking at what it's trying to teach me. So is it trying to teach me I want to own the least amount for the most amount of money made?
We're going to talk more about that when we talk about but yes, it is about, especially, so the rest of you that don't know, Alexis, how old are you? You're 22, 21?
24. I just turned 24 not that long
ago.
All
right. Awesome. So when we are young, we tend not to have a lot of stuff, right? We tend to not have a huge pile of cash. And so leveraging that cash so that it will support you is a bit of a job. And so debt can be a tool to help you do that. But do you want to have as much as possible? We're going to get into that a little bit when we talk about risk, because I think we don't want to be overly, there is an optimum point. We want to optimize between the rewards produced by leverage while mitigating the potential of it taking us down. Does that make sense? So again, if we have a business like Enterprise 4, we really don't want to be heavily leveraged, and we are. Whereas if I have a business more like Enterprise 1, I'm pretty comfortable increasing leverage there. All right, good. Before we leave this, let's talk about ROE versus ROA. Walter, would you please?
Yeah, a real quick, John's got some things he needs to correct there, but the real quick and dirty way to actually see if interest is adding to your, if you're making money on your interest, is to divide ROE by ROA.
Which I got a demo of right here.
Right. So if that is positive, or greater than one, then the debt is adding to the mix, which is what you want. Is what you want to have.
The number's negative, it's a no-brainer.
Right.
And it's positive because you're dividing two positive numbers. You can have two negative numbers and get a positive. That's not what you want. If any of these numbers are negative, you're out. But if it's positive and greater than 1, then your debt is actually contributing to the business, right, Walter?
Correct. That's correct.
Okay. Now, I'm going to just add a quick comment here. We're going to come back to this in a little bit after we look at some examples. To my mind, it needs to not just be greater than 1, it needs to be significantly greater than 1.
Great comment.
Okay, because if I can earn 5.1% and borrow at 5%, I'm not making enough to cover myself for any risk. So I am always trying to get that spread significantly large enough that it's attractive. Large enough that when I tell my wife, hey, we're going to borrow some money at 8%, she goes, oh, yeah, that's a no-brainer. And again, we're going to come back to that in a little. Here's a quick example. I just pulled, these are real numbers out of the wild. We have a net income number here that's basically $145,000. You can see our opening equity number is 369. Opening assets is 941. What is something we know about this business right away? Just with those numbers. Hi, Treg.
Hey,
You want to answer that?
no, sorry.
You just got here, I understand. Is that a squirrel you hunted behind you?
Coyote, yeah.
Cool them out. If you see an opening equity number that's 370 and an opening asset number that's 950, what do you know about this business?
Heavily leveraged.
Heavily leveraged, right? Hondo, this is an oil company like you're used to, right? Exactly. Now, Walter's quick test. Now, the other thing we notice, though, when we look at the net income compared to either the equity or the assets, is it good, bad? Would you take those numbers?
Yeah.
Pretty good,
Yeah.
right?
Yeah, they're good. I mean, you should be using the 144 less 41.
Less the interest, correct.
Right.
But either way, we're in the ballpark of a pretty good number, right?
Right. That's right.
So then when we run Walter's quick test, which I really like, we have 39% ROE, which is greater than our return on asset. And so then we get a significantly positive number greater than 1. When we look at his debt to equity ratio, right, we see that we have, right, about 675 in liabilities, and somewhere there's a disconnect here. This must be an end of year number that we switched to there, so I apologize for that. Our cost of liabilities, we are averaged across all debt, and so our effective interest rate, if you will, is 6.07%. And if we take our return on assets minus, so the 15.34 minus the 6%, right? We get about 9%. And then we multiply that by the leverage and we get an 11% debt impact. Okay, here's another example. We've got opening equity of 228 and opening assets of 582. What do we think about the leverage on this business? It's not half, but it's not far from there, right? It's probably in that 40% range. 40% equity, that is. Okay, what do we think about the return on assets in this business? At 40%. Are we happy with that? Yes, no, maybe so. Walter, would you take 40%?
Yeah, I'd take 40.
Okay. Would you take 105 on your own equity? Annualized, what does 105% do for your equity every year?
Doubles it.
It doubles it. That's exactly right. So you started with equity of 228 and you finished with equity somewhere in the neighborhood of 450. So that's a nice change. Okay, so then again, we look at our quick test, significantly positive. We look at our leverage, how big a lever are we using? We look at the difference. Our effective interest rate here is 4%. Our return is 41, so we have a big spread there, and we wind up with a debt impact of about 50%. So again, debt is significantly positively impacting this business. Look at another one here. All right, we've got a 1.6 million and 5.2 million. Somewhere there's a screwy number in here, but I'm not sure what's going on. Equity 2. This must be the average equity for the year, I'm guessing, is the number I used there. How heavily leveraged are we?
Yeah, real heavy.
Pretty heavy.
Right.
Yeah. How does our quick test look? I would say our return on assets is okay. Would you agree with that, Walter? 20% it's certainly a good number. It's not exceptional.
Right. But your debt to assets 70%, so that's pretty high.
That's very high. But our return on equity, therefore, it's a leverage number. Now we have added, in my mind here, a significant amount of risk there, but it is producing income. And what we see again is about 30% is helping us. One of the things that's helping us here is we have a pretty low effective interest rate. This can happen a number of ways. Remember, we average all of the interest payments against all of the debt. Sometimes this is family lending. Sometimes, you picked up some 0% loans on equipment, that sort of thing. There can be a lot of things that pile into this, but money in this operation is very cheap. Okay, we're going to do another one here. This is similar to enterprise number 2. I've got a few things on here that I don't want to dive too deeply into, but the biggest thing is we do have a positive return on equity here if we use net income without interest, okay? And we have a positive return on asset, but neither of them are good because they are significantly lower than our cost of capital.
Right.
Okay, so you can say, oh, I have a profitable business or I have a positive return, but when you add debt, it becomes bad. So we want to make sure we don't, again, there are lots of cases where it's close and we want to definitely stay out of those. So again, in this business, debt is taking additional money away from the business. All right, Alexis, this goes a little to your comment. And one thing I want us to all be very aware of, that when we increase the debt in the business, and so here is debt expressed as a fraction right here. When we increase and add more debt, we can certainly add to our positive returns if we have a positive gain in the business, and we can significantly increase our negative returns. So these are both modeled at, this is a 25% return on asset. This is a negative 25% return on asset. And then we see how that is impacted by a 20, 40, 60, 80, 100% leverage, if you will. And one of the things that becomes important is that as you lose money in a business, you go down faster, right, with additional costs of capital. Questions or comments about this? I don't necessarily show you this to scare you, but to just make sure you're aware of what the risk is. All right, and here's back to our question about what level of risk is acceptable, how much debt should you go into? I think it's very easy for me to split the risks into upside and downside. And yes, Caleb, there is a similar diagram to that in the RFP manual. There are cases that I look at where we see the sort of what I'll think of as easy decisions or no-brainer decisions. You can get into cases where there is a very small upside potential with a very high downside risk. And you can get into the opposite situation where there's you might lose $100 and you might make $10,000. Okay, that's one thing. Or we look at situations sometimes where there's an opportunity to add a lot of downside risk and the potential of making $100 on the upside. To my mind, probably 50% or more of the situations we look at, if you just look at those two alternatives and how they compare to one another, you can pretty much quit the decision-making process right there. There are lots of them, though, that aren't easy, where it's, you know, it's maybe a little more balanced, and maybe, you know, maybe there is a risk that it goes really well or a risk that it goes really bad. In those cases, I think we want to think about a bunch of things. First off, your context really matters. If you're 85 years old, you may have a different risk tolerance than someone that's 24. If you have a lot of assets, you may have a very different risk tolerance than someone that doesn't have a lot of assets. If you have a lot of cash or working capital, you may have a different risk tolerance. If you've got a young growing family, you know, if you live in an extreme environment, all of those things are going to play into what decisions you make. Please never, 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 never discount risk. We always want to think about it, and I think about it often in terms of percentages. So I might say, yeah, there's a 50-50 chance that this good outcome happens. Well, if that good outcome is $100,000 and I multiply it by the 50-50 risk, then that becomes the potential of a $50,000 outcome. If it might be 100,000 or it might be a negative 100,000, then the expected outcome really is basically zero. If it's very even positive or negative. I mentioned the mitigating factors. Sometimes we can look at a situation where we can change the risk profile based on something like an LRP contract, based on our ability to hedge things, based on having alternates. We can also increase risk by doing the opposite of all of those things, right? We increase risk when we push our production to the limits. We increase risk when we, you know, sort of run in what I'd consider sort of an unsustainable type of system. So running your grass right to the max, running your people to the max, that sort of thing. Those are all things that, you know, sort of increase risk without necessarily changing the financial profile. Anything we want to add to this? Walter, you want to add anything here?
Well, I think that I think maybe some of you heard me say this before. There's this, I mean, what, like the context piece and what, you know, the bullets there that John is laying out. There's a piece where we need to know ourselves. And I'm just going to use you know, Bud Williams could turn the inventory 52 times in a year. I mean, he would do a weekly trade. I'm just using that. I mean, to make something extreme.
Mm-hmm.
But we may not have the skill sets to do that. So maybe we're only going to do it 3 times in a year if you're doing a soccer deal. So there's a know thyself piece here that you really got to I'm gonna call it's a soul search.
Yep.
In the process.
Yep. Very, very good. Good. Jordan Steele, do you want to add anything to this? Oh, maybe Joy and Rick Stevens do first. I see your microphone's off.
No, John, I think you've covered it. The only example you didn't cover, I think, would be a positive ROA. No, yeah, a positive ROA, but a negative ROE, meaning there's a profitable business, but your lender's getting all of your profit, literally all of it.
Yep.
So I've seen those situations. And then I love doing your examples because this process that you went through is what makes it so hard for us as, I'll call it, coaches or consultants, because there's so many moving factors in there. I mean, we've all switched decisions on which enterprise we want, but until you know all of the details, you can't make suggestions.
Just knowing the gross margin's not enough. Just knowing the interest rate is not enough. Yeah, all these things can get you in trouble.
Yep. Okay. And then Walter brought in the people part of it too. So
yeah,
that's
another piece of this is, I mean, it's good to do the comparisons. I mean, John and Jordan and the team are doing a great comparison of, you know, what's this data set that we have, you know, all the folks that are in Ranch Right, but sometimes you have to think about it. That's okay, but you really need to really start thinking about how does these decisions affect me. Correct. And I want to make sure that and I'm not saying it's all about us, but I think we need to think about that.
Walter, I actually am going to argue with you on that because I think it is really all about us. You know, Treg Ulmer, your job is to run your business.
That's what I'm getting at. That's what I'm getting at, John.
Yeah, and I think you can be 100% selfish in this department, and we can all do this differently.
That's right.
Because it is our business, and it matters what we like. And some of us, some of us have different tolerance from our spouse for that, and we have to come to agreement there within our household and within our business. We have to come to agreement, but I don't have to do things the same way Treg does, and Treg doesn't have to do things the same way I do. And that is what makes America great, is that we all have different ways we can do these things. So
yeah, and
it makes our industry great.
Yeah, and I call that the pillow talk piece.
That's exactly right. Explain that a little more, Walter.
Well, the day is done. The lights are turned off, and you and your spouse are maybe the fan is going on in the room that you're in, and it's maybe there's a little hum that's going on, etc. But there's some priceless time that occurs, when your head is on the pillow in that bedroom. And I'm not trying to be, it's not a kinky comment or anything like that.
No.
I mean, I had a really good friend. I mean, I know I'm in Illinois, but a really good friend of mine that has a great farm operation, multi-gen, nice size. He shared that with me one time, and that's one I come back to, because it's about the relationship, even within the doors of our house.
Yep, totally agree. You would have been proud of me. My pillow talk the other day was my 265 LRP contract. I was so excited about that. I couldn't wait to share it. $2,200 per steer makes the purchase look a lot more reasonable.
Yeah.
All right. Any other questions, comments, thoughts?
John, I have a question.
You bet. Is this Michaela? Yeah.
When you talk about the high downside,
mm-hmm.
I'm trying to think of like the different types of debt. Like, you could have debt on equipment versus livestock. When you talk about a high downside, is there a certain type of debt that tends to fall into that category?
I'm referring there not necessarily to the debt, but to the practice.
So,
right.
like, if I bought a lot of extra cattle and didn't have good practices, those extra cattle would lose me a lot of money.
Correct. So, or yeah, I mean, so for example, cattle are very expensive now. Or let's go back. This is a totally different example, but I think it illustrates it really well. 3 years ago, if you had a variable rate mortgage at 2.5%, what is the chance that your mortgage rate is going to go down significantly, like enough to like cause you positive benefit, versus what is the risk that mortgage rate is going to go up?
Right. It's very likely.
Right. And now we can see this we're looking in hindsight, right? So we're a little biased here, but I think when you have something like a 2.5% interest rate, there is a significantly greater probability that it's going to go up by, the chance of it going to zero is very low, right? So, and that would be a 2.5% move. The chance of it going to 5 seems very reasonable to me. So that would be a good example of a skewed risk profile. I think we see it in production systems where, again, if I go buy, and again, we've seen $4,500 cows sell. If I go pay $4,500 for a cow right now, to my mind, the risk of that cow going up in value is significantly lower than the risk of that cow going down in value.
Right.
Does that make sense? So if I'm going to borrow, let's say I'm going to 100% leverage a cow at $4,500 versus 100% leverage a cow. Let's say I found a bunch of good bred cows for $1,400 right now.
Right. That makes sense.
Okay. Cull cow price is going to keep them at $1,400. Whereas the potential to get a $1,500 calf and sell a $2,000 cow is going to, that to me is skewed to the positive. Does that make sense?
It does. Yeah. And that answers my question, because I can just, I can just hear people saying, well, if I get in a bind, I'll just sell the asset. But what really matters is, will the value of the asset hold up?
Correct. Yeah. And again, I'm always trying to separate the cash flow and the asset value. If I can participate in only one of those two risks of debt, I'm going to try to do that.
Yeah. Thank
Good
you.
question. Yeah, good. Anything else?
Yeah, I'm trying to. We kind of got past it before I got to wrap my head around the consequence of the return on equity to return on asset ratio, and that
Okay.
being greater than one, and the higher it is, the better, and what that means, and if it's lower, like what does it mean if we're at or below one? What is happening there?
May I help you there, John?
You bet, please.
Big picture, Hondo. The debt is not. You're not getting excuse me. You're not getting any juice out of the debt.
Okay.
Okay. Does that make sense?
Okay. Yeah, because if those numbers are the same, adding debt's not doing anything for you.
That's correct.
Okay. And the top number is return on equity, and then the bottom number is return on total assets.
Right. Because you want to make more money on your money.
Right.
Okay.
The only reason to borrow money is you multiply the effect of your money.
Yeah. So if you're making the same return on your money and the entire assets, then the debt is not giving you any additional juice, like you were saying. Gotcha.
That's exactly right.
Okay.
And my name doesn't end in a vowel either.
I've got a question along that same line of thinking.
Okay, go ahead.
Like whenever you're talking about like debt to assets, you can use the ratio in a sentence. Like I think one of your examples was like 1.19 debt to asset, then you have $1.19 of debt for every asset or dollar of asset that you have. Is there a way to create to use that in a sentence, the quick ratio that y'all were using? It just helps me remember.
Okay, Walter, you're going to help me with this, and Michaela, I may need you to ask it again.
Okay, so on the examples that you were using, several of the examples I think were like around 2.5, like 2.5, or there was one that was over 3. So when that quick ratio is 2.5, what does 2.5 mean?
Good question. Okay. So 1-to-1 would be parity, right? 1-to-1 means that your return on equity and your return on asset are equal. So to my mind, Walter, a number of 2.5 would mean that you have increased your return on equity by that much with debt. Is that correct?
Yeah, I'd have to kind of go through. Yeah,
I think that's true, right?
Yeah, but I'm gonna go. I'm really a debt to asset person, Michaela. I don't know what your background is. Okay, I really I use debt to equity a little, but I'm really a debt to asset person to make it simple. And I guess I'm part of that is I think a lot of non-ags they're debt to asset when they look at stuff. But I look at it that this is just my mindset, so please forgive me. But when you start getting, this is probably comes more out of the farm credit and the farm credit side is they had tiers, okay, and when you had a debt to asset that was 40% or less, you were golden. You could get money, okay? But once you start, once you get once you get above 50, that starts to become a flag.
You're into their money a lot more.
That's correct.
Yep.
Right.
Yeah, and I'm with you, Walter. I think in terms of debt to asset, so I am 50% finance, 40% finance, that sort of thing.
Right.
But
the other one I want, I guess, for the there was that discussion there. There was that discussion about buying a truck and going out and borrowing on the truck. So what you would want to do on that one is, John or Jordan or whoever, you could have, I mean, to be objective about it, you would have been looking probably at a debt servicing ratio. How much was that when you looked at that, what you had before you made that debt payment as, when you were trucking. So if you were making, I'm just picking a number, that you had 6,000 before you were making that $5,000 payment. Okay, so that would have been a 1.2, right, John?
Mm-hmm.
Okay, so then if you had 6,000 and now you dropped that payment back to she dropped it from 5,000 to 2,000.
Yep.
Yeah. So
Yep.
that went up to 3-1. That is huge. That is huge. So anyway, that's just something you might want to think about in the process.
Okay, thank you very much.
Yeah.
And that particular example has multiple positive impacts, right? And one of the positive impacts is increasing free cash flow.
Right.
Right. That then allows additional work, if you will, by that same money, if that's what you want to do. And frankly, builds in more resilience there.
John,
go ahead.
With my truck example, so yeah, I went from 5,000 down to 2,000. And that was the 23% interest over 3.5 years. Well, then I refinanced it just like a month ago, and for 10%, but I did it over 4 years, so the payment went down to $1,200 some dollars,
right.
Which freed up cash. But I'm starting to wonder whether I still want to pay 2,000 on it, because can you talk about like extending out debt? Is it better for like, obviously I have more cash now, but I'm going to owe more interest in the long run.
Yep.
Versus paying it off. So like, how do you balance that?
Good question. Walter, you want to answer that one?
Okay.
This is a great question.
Yeah. What I would look at is, I would look at your expenses that you have. Okay. And on an annual basis, and I would divide them by, I don't know what all is in that business, but let's just say it's the trucking piece. I would divide that by, say 12. Okay. And then figure out how many months worth of expenses that you want to have, because you could be, you want to keep your, I'm probably in the camp that, I mean, paying the debt off early is fine, but I don't know what your context is on what your personal goal is. And I want to keep I guess your own working capital. I want to, we probably need to be, moving that to where it's 3 or 6 months of your business, just to do a weather of your storm. Because if you pay too much on it, you're not going to have that if fuel prices go up. I'm trying to play a little bit on the conservative side.
So let me make sure I clarify what you're saying, Walter. You are saying you would choose, depending on the context, there are a lot of moving parts to this, but you would be looking at how much more cash does that allow you to sock away to have in the bank? Even though you are borrowing money, you might not be super aggressive about getting it paid back in order to allow yourself to build up a buffer, or you can call it an emergency.
Because I mean, paying ahead, you're not going to have that. Yeah, I mean, I'm making an assumption that you may not be at that working capital number that you need for a business.
Yep.
And that can be priceless.
Yep.
And I guess that's my coaching tip today.
That is very helpful, because the 10% interest, he's right. Like, I don't have enough working capital compared to the amount of accounts receivable I have. So having that cash he's saying, is like more beneficial than the 9% savings, right?
That's right.
That's right. Walter, would you ever consider, when you look at that over the course of a couple of years, would you consider the value of the underlying asset?
I'm not going to go there.
Okay. Very good. Interesting.
Yeah. Let me give you an example.
Sure.
Okay. One of the guys in my old office, he worked for the Illinois Farm Development Authority. And let's pick on another industry because I know we all love it. Okay. It's the big hog integrators. Okay. So the guys would go out and maybe put a farm in hock, and then they'd spend whatever, 2 million on a hog building, bring the son back, that. Well, hog prices are good, and so they pay ahead on that loan. Well, then they go to $8, and you can't get the working capital back. Does that make sense, John?
Oh yeah.
So, but anyway, that's just, I mean, it's knowing your business and your context and what you're comfortable with.
Yeah, and the problem with that is exactly what you say, is once you've paid, unless it's a revolving note, once you've put money on it, you can't get it back.
Right, because what they were doing is they were paying down their intermediate debt that they had on the hog buildings.
Right.
Or maybe it was long-term debt too. But so anyway, that is one that you want to have strong liquidity, and that's a tip that I think that John and his team advocate for, and that's I guess a piece of wisdom that I stand for also.
And I think that's one that whenever I talk to someone that has done this for a few decades, the older you are, the more you emphasize it, right? You've seen a few more bad things happen where cash sure comes in handy.
What are you trying to tell me, John? I'm old?
No, I did not say that to you. As one progresses. Okay. I'll tell you, I just had a conversation with a customer this morning who is at a cash position that he has never been in before. And he said, I had no idea the emotional toll that it was taking not having any liquidity.
Right.
And he's still not where he wants to be, but he is in a very different position from the sort of day by day type situation he was in. And getting out of that even a little bit, even if it means going to 30 days, is a big relief. If you know you can make your next payroll, right, you can make your next rent payment, you sweat about that more than you think while you're sleeping. So that is something that really does matter, and it affects relationships. And I think that's the part we often undervalue. It affects our relationship with our spouses, our kids, our neighbors, all that.
Well said, John.
Thank you. All right, Brett asked a question in the chat. He's filling his sprayer maybe still, so I want to get to this. He said, how much lead time will a business have on debt becoming a problem? And I think I know what you mean by this. And then his question is this something we, Ranch Right, are able to see coming before it's a big problem? I mentioned early on the stress test thing. When we were in our 2.5%, 3.5% interest rate environment, someone else tipped me off to the fact that, boy, a person should be doing a little bit of stress testing on interest rates because they could change. And lo and behold, they did. Now, the lead time is an excellent question because sometimes, depending on the environment, usually the lead time is reasonable. But there are situations like the last couple of years where the lead time is really almost nothing. I've mentioned before the variable rate mortgage situation. And there are a number of people that got caught with a variable rate mortgage that you know, the balloon payment or the adjustment or whatever was due right when, you know, right when mortgage rates really went up. And so in that particular case, it was literally a situation where the next payment was 50% higher than the prior payment. And I'll tell you what, that's pretty hard to respond to. Not many of us have the ability to have our mortgage go up by 50% and still the mortgage payment go up by 50% and still sort of be able to function. But this is one of those cases where it's another punctuated equilibrium situation, right? Nothing happens for long periods of time. I think our interest rate has been at 8.5% for how long now, Walter? It's been a year or so, hasn't it?
Yeah, right.
Nothing's happened. So in that period of time, right, it doesn't matter. We have time to make adjustments, but there may be, you know, when something unexpected happens, right? When a 9/11 happens, when a 2008 happens, you know, there are things where there will be rapid change, or there is the potential for it. So I think this is something that we always want to have ourselves, you know, sort of aware of. And again, it speaks to the having cash. There are times when that will buffer you against the short-term impacts. And just like having feed in the barn, if you have 30 days of feed in the barn, when the big blizzard hits, to my mind, 30 days worth of feed at least buys you time to get to the next good decision. And so you may choose to buy feed, you may choose to move cows, you may choose to do a bunch of things when the blizzard comes. But if you can at least weather the first wave of it, then you have purchased time that allows you to then make a good decision of what do you do next, because you don't want to have to do that in, you know, 48 hours or 72 hours. You want to have some time. It is hard to make a big change to your debt situation often in a 3 or 6 month period. Usually that is something that happens over the course of at least 12 months. And there are all kinds of reasons for that. So I hope that answers your question. But yes, this is in answer to the second part of your question, which is this something we can help with? One of the things we are doing fairly regularly with you is, and with all of our customers, is looking at return on asset, return on equity. If those numbers are low, you know, some of you have heard us sort of sound a warning bell that says this is not where we need to be. If this is going to go on for the long term, we want to be more profitable. One of the reasons I love showing examples of highly profitable businesses is because I want to push all of us to be better, right? To expand, because I agree with Wally in that a big margin buffers you against all kinds of things. A big margin takes care of high interest rates. A big margin takes care of variability year to year. It is easier to build up good working capital with a big margin. It is easy to find and purchase assets at a discount during times of distress when you've had a big margin and have lots of cash. So
there's one more, John, before debt, the lead time. If you once you guys get used to reading your gross product, which would be your trading account or total income in QuickBooks, once you get used to reading those reports, you can see a lot of things coming there. So, you know, one example would be if I see a big gross product, but most of it is in the inventory change, then I know next year cash flow is probably not going to be a problem.
Yep.
And then on the flip side, if I have the same gross product, but my inventory change is negative and my revenue is big cash, then that's when, okay, so then 1 year your cash is big. And then the next year is when you borrow on the line of credit. So, I mean, when I read your question, Brett, about a leading debt indicator, like it takes years. I mean, once you get used to it, you can see it coming for several years. And it all starts since we're on it, it all starts in gross product, like John's webinars here.
Well, another piece of that too, Jordan, is to actually do, this is, I think, something that, you know, we need to be aware of. I mean, I think sometimes the clients don't realize that you can print multi-year reports on the same page.
Yep.
Okay. And I'm not beating anybody up. But when you put 5 years together, I mean, I know a lot of you haven't been with John 5 years, but when you put 5 years together, I mean, I mean, you can see lots of stuff. You can see lots of stuff. I mean, I'm doing one on I told Jordan and John, I'm working on a little short line business, which, is say the auger wagons, the batwing mowers, whatever. But anyway, I mean, when you start to put some of that together, I mean, it's powerful information.
Totally agree. And I want to second something that Jordan said, which is something I feel like I've been repeating a lot, which is inventory is a strong predictor of future income. And I agree with you, Jordan, that when you create, you often have to create economic value first, and then the revenue comes after that. Now, often we're doing that in the same year, right? We create economic value and then we sell it. But there are lots of times where we're creating economic value this year and then capitalizing on it next year. And you capitalize, meaning turning it into cash the next year. So those positive and negative inventory changes are often predictive of our future cash flow. It's a struggle sometimes to find leading indicators in our industry. That is one that's one of the best ones, I think.
I'm going to go there, John, for a second.
Love it.
One that's out there that's not in the books, okay, John, is the cow pie.
Uh-huh. Right.
Okay, so just think of that one.
Yep. No, very good. Phil is another one I love to watch. When we're looking at a herd of cows, what are the things we can see ahead of time that tell us of what the outcome is going to be later? So those all go together. All right. Thank you very much, all of you, for attending today. If we have additional questions, I would be more than happy to talk to you here. I'll hang out for a little bit, but I'd like to let the rest of you go. And again, thanks for attending. I really appreciate it. We have wonderful attendance today. So please join us again next month. It'll be the third Thursday. And Jessica will send out notices again on social media and via email. So if you want to continue receiving those messages or you want to receive those messages and you are not currently, please make sure you get your email to Jessica. And then we also post these videos, a link to them on our YouTube channel on our website. So you can search Ranch Right LLC on YouTube and find us. You can also jump on the Ranch Right LLC website and find all of those videos there. So great to see all of you and have a wonderful afternoon. Thank you again for coming today.
Thanks, John. We'll see you.
You bet. Thanks, Jordan. Appreciate you chipping in.
I messed up my time zones, John. I was off by an hour.